Ladies and gentlemen, this is a strategic market breakdown regarding the escalating conflict between the United States and Iran. President Donald Trump has officially announced major US combat operations targeting Iranian military infrastructure. And this is no more a diplomatic tension, this is military escalation. And the markets do not ignore war. All right, now let's break this down properly so that you understand. When geopolitical conflict erupts at this scale, markets immediately shift into what we call risk off mode. That means capital moves out of speculative assets and into safety. The first thing investors look at is the US dollar. In the short term, the dollar softened. They often strengthen during global fear because it is still the world's currency reserve. Global capital runs towards liquidity. Treasury markets get demand, and that supports the dollar. However, and this is important, if this war becomes prolonged and expensive, and if oil prices spike aggressively, inflation, speculations rise, and that creates pressure on the Federal Reserve and can eventually weaken the dollar medium to long term. That's when when they make the war longer. Now, short-term potential, dollar strengthens. Long-term depends on duration, cost, and oil. Depends on the duration. Now let's talk about gold. All right, gold thrives on uncertainty. Gold thrives on geopolitical instability. Gold thrives when investors do not trust political stability. So we are already seeing safe haven flows into gold. If escalation continues, gold remains structurally supported. If tensions come down quickly, we may see a pullback. But as long as risk remains elevated, gold has a bid underneath it. Now, silver behaves similarly, but with more volatility. You will see silver is thinner, more emotional, more speculative when gold moves. Silver often exaggerates the move. That means higher upside potential, but also sharper corrections. Now, the real hidden variable here is oil. All right, if this conflict disrupts energy supply routes, especially around the Strait of Hormuz, all right, oil prices could spike aggressively. Now listen to this. If oil pushes significantly higher, that feeds directly into global inflation. And inflation changes everything. Higher oil means higher transport cost, higher production cost, higher inflation expectations, and that pressures central banks worldwide. Now that creates currency volatility. Now in that environment, the market readjusts. The Japanese yen and the Swiss franc typically strengthen as safe havens. Emerging market currencies usually weaken due to capital flight, while exporting currencies like the Canadian dollar can benefit if oil remains elevated. So here is a strategic framework, all right, that you can look at. Scenario 1: limited conflict, contained retaliation. Markets would spike in fear, then normalize. Gold pulls back slightly, dollar stabilizes. Scenario number 2: oil disruption and then prolonged military engagement. Gold remains strong, which means it go up. Silver becomes volatile, but bullish bias. Dollar initially strengthens, then becomes more complex depending on inflation and physical cost. Now, emerging market currencies face pressure. Scenario number 3: wider regional escalation. Sustained risk of environment. Capital preservation becomes dominant theme globally. Now understand this clearly, guys. The markets are not emotional. They reprice risk. That's it. As traders, And as investors, we don't need to react emotionally. We assess probability, we measure volatility, we respect invalidation. This is not time for recklessness position. This is time for disciplined execution and the capital protection. Now, war increases volatility. Volatility creates opportunity, but only if those who manage risk properly. So at Continental Capital Institute, we do not trade headlines. We trade structure. We trade probability. We trade risk-adjusted setups. Stay disciplined. Stay strategic. More updates are coming as this develops. See you.